Welcome back to the Disciplined Trader, powered by bellsforex.com, where precision meets strategy, and disciplined execution is your secret weapon. Today, we're exploring one of the most powerful tools in modern trading, quantitative analysis, the art and science of using math, statistics, and data to understand the markets and make informed trading decisions. Quantitative analysis, or QA, isn't just for quants in a lab with supercomputers. Even as a retail trader, understanding the principles behind QA can elevate your strategy, help you manage risk, and refine your execution. At its core, QA is about taking the guesswork out of trading and replacing it with data-driven insights. Let's break it down. Quantitative analysis relies on three pillars: mathematical models, statistical techniques, and computational algorithms. Models like Black-Scholes for options pricing or CAPM for estimating asset returns allow traders to create structured expectations. Statistical methods, think regression, time series analysis, and Monte Carlo simulations, help forecast market behavior. And computational algorithms, increasingly powered by machine learning, allow us to scan massive datasets and even execute trades automatically, like in high-frequency trading. But here's the key: all these tools work together. They're not magic bullets, they are ways to interpret market behavior with precision. Reduce emotional bias and quantify risk. Let's talk methodology. Time series analysis, for example, is foundational. By looking at historical price data, traders can spot trends, cycles, or anomalies. Moving averages smooth out the noise, while ARIMA models combine past values and moving averages to forecast potential price movements. Regression analysis, whether linear or multiple, allows you to quantify relationships between market variables. Factor models break down returns into market, size, and value components, giving you a structured way to understand performance. And machine learning? That's the frontier, detecting patterns humans might miss and creating adaptive strategies that evolve with the market. Applications of quantitative analysis are everywhere. For risk management, QA helps estimate potential losses using models like value at risk, VAR, or conditional value at risk, CVAR. For portfolio optimization, it helps allocate assets efficiently, balancing returns and risk along the efficient frontier. And when it comes to trading strategies, quantitative methods underpin arbitrage, statistical arbitrage, and algorithmic trading. To illustrate the power of QA, let's look at a real-world example: Renaissance Technologies and the Medallion Fund. Founded by mathematician Jim Simons, Renaissance has become legendary for its quantitative strategies. The Medallion Fund, launched in 1988, uses machine learning, statistical arbitrage, and high-frequency trading to spot inefficiencies and execute trades at a speed and precision few can match. The results? Annualized returns of about 40% after fees, consistently, a record that is practically unheard of in the industry. The lessons are clear: decisions grounded in data, continuous innovation, and rigorous risk management create exceptional outcomes. As Simons famously said, in mathematics, you look for patterns. In markets, patterns can be your edge. Now, I'll add a trader's perspective from my own experience. Even as a systematic trader managing smaller accounts, the principles hold. When I apply quantitative techniques, whether using moving averages to smooth price action or testing machine learning models on historical data, I find that I'm less reactive, more disciplined, and able to manage trades with confidence. QA doesn't replace intuition, it sharpens it. It allows you to test your hypotheses, quantify probabilities, and make decisions that align with your risk tolerance and strategy goals. But remember, QA is not foolproof. Markets evolve, data can be misleading, and overfitting models can give a false sense of security. That's why risk management is inseparable from quantitative analysis. Always define your exposure, set stop losses, and treat your models as guides, not guarantees. So here's the takeaway: quantitative analysis is a powerful framework for understanding markets, making data-driven decisions, and refining trading strategies. Whether you're studying patterns, running simulations, or coding a simple algorithm, QA enhances your discipline and your edge. The Renaissance case shows what's possible at the highest level, and even small-scale traders can benefit by adopting these principles in a practical, disciplined way. Now I want to hear from you. If you could use quantitative analysis to improve one aspect of your trading, strategy development, risk management, or pattern recognition, which would it be, and why? Drop your answer in the comments. I'd love to hear how you're applying data-driven thinking in your trading journey. Until next time, stay disciplined, stay curious, and remember, the markets reveal their secrets to those willing to study the data, test their models, and execute with patience and precision. See you soon. Bye for now.
Thank you for listening to The Disciplined Trader, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.